Credit cards drive U.S. consumer debt over $894 billion. But here's a surprising fact. As of the latest data available, American consumers carried over $894 billion in revolving debt at some point. That's nearly $1 trillion in credit card bills hanging over people's heads. So why is it often easy to accumulate debt and difficult to pay it off? Let's explore the numbers behind consumer credit trends. First thing, we're talking big bucks here. As of 2022, revolving debt primarily from credit cards rose by $89 billion in just 1 year. That's more than the GDP of many small countries. But let's make this concrete. Imagine a stack of pennies stretching 34 miles high. Each penny represents $1,000 of that debt. Now, think about your monthly bill. If you carry a balance on your card, it's likely because you're paying interest rates. On average, credit cards charge around 15% annual percentage rate, a PR. That means if you borrow $1,000 and don't pay it off right away in 1 year, you'll owe an extra $150 just for borrowing the money. But here's where things get tricky. If you only make minimum payments, which are typically around 2% of your balance or more if the balance is lower, it takes a long time to pay everything back. Let's say you have that $1,000 debt at an annual interest rate of 16%. It would take you over 6 years and cost nearly $459 in interest just to clear it. So why do people keep using credit cards? One big reason: they offer rewards. Think points for groceries or cashback on travel purchases. But here's the catch: to get those perks, you need to spend more than you would otherwise. On average, for every dollar over your normal spending that you charge to a card just to get rewards, you could be paying up to 16% in interest annually if you carry a balance. Now let's look at another trend: credit limits are increasing. In 2021, the average limit on major credit cards rose by $563 per cardholder. This means that more people have access to larger amounts of credit. However, higher credit limits can lead to bigger bills if you don't pay them off in full each month. Next, let's talk about late fees. If you miss a payment or pay less than the minimum amount due, you'll get hit with a fee. As of 2021, that average fee was around $38, according to the Consumer Financial Protection Bureau. For some cards, particularly high-end or luxury card offers, it can be significantly higher but typically does not exceed $400. So here's a question: do these fees and high interest rates ever make up for their costs? Let's break down the numbers. Say you have an outstanding balance of $5,000 at 16% APR if you make only minimum payments, which are often around 2 to 4% of the balance. It typically takes more than 8 years to clear that debt and costs over $3,200 in extra interest. But here's the thing: while banks do earn income from fees and interest rates regardless of whether you pay back loans on time, they still have significant incentive to ensure that borrowers can repay their debts. This is because timely payments reduce the risk of losses due to defaults. That's why they often encourage responsible spending with rewards programs but also impose penalties when payments are missed. Now let's talk about credit scores. Your score is influenced by your credit utilization ratio, which is how much of your available credit you're using. Keeping a high balance relative to your limit can hurt your score. But here's the twist: paying off that debt helps raise your score quickly. But why do people still carry balances? One major reason: emergencies. People use credit cards for unexpected expenses like car repairs or medical bills, figuring they'll pay it back eventually. The issue is, once you start carrying a balance, it's easy to keep adding more charges without ever fully paying off the previous amount, leading to accumulating interest and potentially higher debt over time. So how do you avoid getting into this cycle? One way is to build an emergency fund. Having cash set aside for unexpected expenses reduces the likelihood of relying on credit cards. Another tip: examine your spending habits. Reducing non-essential purchases and focusing on paying down existing debt can be beneficial. Each dollar directed towards the principal rather than interest reduces overall costs over time. Now here's a concrete example. Let's say you have a $10,000 balance at 18% APR if you make minimum payments of about 2 to 5% of the balance each month. It'll take over 9 years and cost nearly $7,694 in interest. But if you double your monthly payment to clear the debt faster, you'll be done in just under 3 years with only around $1,387 in interest. So why do credit card companies still offer so many rewards programs? Because they rely on the fact that many consumers carry balances from month to month, allowing the companies to earn revenue through interest charges and fees. This is how they generate profit, not necessarily by keeping customers in debt longer, but by encouraging spending that leads to ongoing financial relationships with cardholders. But here's the kicker: even if you manage your cards perfectly, the financial industry is designed to benefit them more than it benefits you. That's why understanding these trends is crucial. When you know the math behind credit card usage, you can avoid falling into traps that cost you money over time. Keep in mind that this information is for educational purposes only and not intended as personalized financial advice. Now let's look at another trend. Consumer debt isn't just about credit cards. Total revolving debt has been rising steadily since 2019, jumping to $873 billion in Q4 of 2021, from around $635 billion in Q4 of 2019. That's an increase of more than $238 billion over just 2 years. But why? Partly because people have been turning to credit cards for necessities they cannot afford outright, such as groceries or fuel. During the pandemic era, spending on essential items increased significantly due to rising prices and stagnant wages, forcing many individuals to rely more heavily on credit cards. Another factor is rising prices. According to recent data from the Bureau of Labor Statistics, consumer prices have risen by about 8% over the past year. This increase means that an extra $10 can quickly turn into a significantly higher cost for everyday items due to inflation. When everything becomes more expensive, it's easier to fall behind on payments and accrue interest. Now let's talk about delinquencies. A delinquency is when you miss a payment by at least 30 days. In the fourth quarter of 2020, revolving delinquencies were around 5%, meaning 1 in every 20 cardholders was late on their bill. That's up from just over 4% in Q4 of 2019. But here's a surprising fact. Even those who are current with payments can face challenges. With many consumers carrying credit card balances, the average cardholder often pays significant interest charges and fees, not for exceeding limits, but simply by maintaining a balance within their limit. So what's the solution? It starts with awareness. You need to know exactly how much you're spending on credit cards each month, and how your rewards compare to the costs associated with using those cards. Here's a simple test. If your interest payments on consumer credit exceed the value of any cash back or rewards you earn, it's not beneficial for you financially. The math simply doesn't work in your favor, but let's go back to that emergency fund idea. If you have $1,000 set aside for unexpected expenses, you're less likely to need credit cards when the car breaks down or a medical bill comes due. This money can help cover these costs without incurring debt and avoid interest charges altogether. Now here's a twist. Even if you don't carry balances, using credit cards can still impact your finances negatively through late fees, annual fees, and other transaction fees. These fees can accumulate rapidly, particularly if you miss a payment deadline. So how do you avoid these pitfalls? One key strategy is to use cash or debit for everyday expenses. This approach helps you avoid accumulating unnecessary debt and limits overspending. Keep credit cards as a backup option solely for emergencies or significant purchases. Another tip, pay attention to the total cost of your rewards program. Some cards may offer more points but come with higher interest rates or annual fees, which can negate the benefits over time. Now let's recap what we've covered so far. 1. Revolving debt has soared, reaching nearly $987 billion by Q1 2023. 2. Credit card APRs are around 16% on average, though they can vary widely based on credit scores and promotional offers. 3. Late fees for missed payments are capped at $400 under federal regulations, but often lower depending on the issuer's policy. 4. Delinquencies have risen slightly to about 5% of cardholders as of recent data points. But here's the big picture. If you're carrying a balance, it can take many years and cost thousands of dollars in interest just to pay off your debt. Missing payments also incurs additional fees, which can further extend the time needed to become debt-free. Now let's talk about credit utilization rates. This is a key factor for your credit score. The lower the percentage of your available credit that you're using, the better your score will be. High balances and missed payments can quickly harm your score, making it harder to obtain new cards or loans in the future. So how do you keep your utilization rate low? Simple, pay off as much of your balance as possible each month. Aim for keeping your utilization below 30% of your available credit limit or lower if feasible. That way, even if you're not paying everything off right away, you'll still be maintaining a healthy score. Now let's look at another trend, the impact of rewards programs. While they offer benefits like cashback or points, they also encourage more spending to earn those perks. However, every dollar spent beyond your normal budget on a high-interest credit card can cost you significantly more than 16 cents in interest annually if not paid off immediately. For example, at an average annual percentage rate, a PR of 15%, carrying a balance for a year would result in $1.50 in interest charges for each dollar spent. So here's an important question. Is it worth paying extra interest for a few $100s worth of rewards? Let's look at the numbers. If you carry a balance of $5,000 on your credit card and pay an average annual percentage rate, a PR of 18%, you'll end up paying around $900 in interest over a year. That's not even including any late fees if you miss payments or fail to pay the minimum amount due. But let's consider the opposite scenario. What happens if you avoid those rewards programs and stick to debit for everyday expenses? By doing so, you save on potential interest charges and maintain lower credit card balances. This approach reduces the risk of accumulating high levels of debt. Now here's another twist. The financial industry often promotes high-interest credit cards with attractive offers because they know many consumers will carry a balance from month to month. These companies benefit when cardholders do not pay off their entire balance each period, as it allows them to earn fees and interest payments. So how do you avoid getting caught up in excessive consumer credit? It starts by being aware of the costs involved. Examine your spending habits, cut back on non-essential expenses, and prioritize paying down any existing debt. But let's look at one more trend. Consumer spending patterns have shifted significantly in recent years. People are increasingly relying on credit cards for essential purchases such as groceries and gas, particularly amid rising prices. This means that even those who might not typically rely heavily on credit cards now find themselves carrying balances due to rising costs. However, the longer you carry a balance, the harder it's to get out of debt, as interest continues to accrue and can make the total amount owed grow rapidly. Now let's revisit the importance of your emergency fund. It serves as a buffer not only for large unforeseen expenses but also for sudden costs that could accrue high-interest debt if financed through credit cards. By maintaining readily available cash, you reduce the likelihood of accumulating costly credit card debt when urgent needs arise. So here's a tip: start small with your emergency fund. Aim to save at least $500 initially, then continue building it up from there. Every little bit helps in avoiding high-interest debt. Now let's circle back to the big picture. Understanding how credit card companies operate can help you avoid common pitfalls. By staying informed about industry trends and being mindful of your spending habits, you can better protect your financial health. But here's the final kicker. Even if you're managing your cards responsibly, the system is still designed to benefit the credit card companies more than it benefits you. That's why education about credit card usage is so crucial. So let's recap what we've covered. 1. Revolving debt has surged to nearly $987 billion. 2. Credit card interest rates average around 15%. 3. Late fees can be as high as $40 for missed payments. 4. Delinquencies have risen slightly, with about 3% of cardholders late on their bills. And we've seen how these trends impact personal finances. Carrying a balance incurs interest and fees. Rewards programs can encourage overspending, and rising prices make it harder to maintain financial stability without relying on credit cards. So here's the takeaway. Understand the numbers behind consumer credit trends, monitor your spending habits closely, and build an emergency fund to avoid falling into debt traps. Now let's wrap this up with a final question for you. Are you aware of how much interest and fees you're paying each month? If not, start tracking it now. This is one step toward taking control of your financial health. This is educational and historical, not financial advice.